The Federal Reserve does not help the economy. It manages the plumbing, and right now the plumbing is leaking again, which means the next flood of liquidity is not coming to save you. It is coming to keep the system from breaking loudly enough for the public to notice until it is too late. So let's talk about the part nobody teaches in personal finance courses. When rates move and when the Fed stops shrinking its balance sheet, it is not a feel-good pivot. It is a signal of stress in the real economy and in the banking machine that sits underneath it. In 2026, you can feel that stress in your life. Your job feels fragile because AI is replacing roles faster than your resume can update. Your grocery bill still climbs even when the headline inflation number cools. And your housing situation is no longer a temporary struggle. It is a long-term trap. This is financial education, not financial advice. And if you stay with me, you will understand why markets can look euphoric while regular people are bleeding. First, picture the timing. You are told the worst is over. Then you look at your bank account and you realize the worst was never gone. It just changed costumes. The official story is that inflation was beaten, the economy stabilized, and now the Fed can ease off. But the real story is that liquidity is expensive, and the bill always comes due. In the same week that the Fed signals lower rates and pauses balance sheet reduction, you should ask one question that makes most people uncomfortable. What broke, and who needed the crash prevented? If you have ever worked in a business where the leadership pretended everything was fine while the roof was actively collapsing, you already know the pattern. They do not announce catastrophe when catastrophe begins. They announce confidence. They call it a soft landing. They call it normalizing policy. They call it reducing restrictive stance. Meanwhile, the people who understand balance sheets are watching a different scoreboard. They are watching reserve levels. They are watching funding markets. They are watching whether the system can handle withdrawals without panic. And here is the dark twist that turns this from abstract macroeconomic talk into something personal. When the Fed stops draining liquidity, the money does not magically appear in your checking account. It appears where the system routes it. It flows through banks, through asset prices, through high-speed trading networks, and through the pockets of investors who already hold the assets that benefit from liquidity surges. You get the bill later, or you get no benefit at all, only risk. Now let's connect that to 2026 reality, because this is not 2012 anymore. In 2020, governments printed money and pushed it into financial assets. In the years after, AI accelerated productivity, but it also accelerated displacement. White-collar middle-class jobs did not vanish like a dramatic movie villain. They got hollowed out in small steps. Customer support got replaced by automation. Marketing work got compressed by AI tools that produce content in minutes. Basic coding got automated by models that can draft functions faster than many entry-level developers can troubleshoot. The result is that wages feel sticky downward even when headlines say the labor market is improving. At the same time, housing detached from wages in every major English-speaking economy. In the United States, the average home price climbed far beyond what typical households can pay, and it stayed there. In the United Kingdom and Canada, you saw the same dynamic. Mortgage rates rise, but home prices do not fall enough to restore affordability, so families just rent longer and longer. In Australia, insurance costs and risk repricing added another layer of pressure. People didn't just get priced out of buying, they also got priced out of stability. And yes, inflation came down on paper. But your purchasing power did not recover. The goods and services that matter to your daily life did not revert to 2019 levels. That gap is the real injury. It is why you feel poorer even in months when the data looks better. So when the Fed changes course in 2026, it matters not because you care about central bank jargon, but because it determines who gets the liquidity and who absorbs the risk. And the scariest part is this: the people who benefit from liquidity are usually the same people who decide when it is necessary. Let's start with the first uncomfortable mechanism. Buying the bottom is not the same thing as making money. People love the story because it feels heroic. They talk about Warren Buffett and his purchases after the 2008 crash. They conveniently ignore that Buffett did not make money because he guessed the exact day the market hit its lowest tick. He made money because he was a giant with time, discipline, and capital access. He bought when prices reflected fear, not when prices reflected future value. But most people are not Buffett. Most people are not sitting on decades of cash flow. Most people buy cheap with borrowed money or with money they cannot replace. Here's the brutal math that most stories hide. Suppose you buy a stock when it is down. It was $100, now it is $50. You feel smart, but your profit only exists when you sell at a higher price. If the stock never recovers and stays at 50, you do not have a realized gain. You just have a position you are trapped inside. And if the market continues to bleed, you will face the second brutal truth. You will be forced to sell at the worst time, because life demands cash. Rent comes, bills come, debt payments come. That is not emotional, that is math. I want you to picture a specific kind of person. A mid-30s nurse in Chicago named David, not lazy, not unskilled. He did everything right. He even stayed in the profession through the hardest years. In 2020, he started investing because he thought it was steady. Then his car needed repairs and he had to take out a loan because wages did not keep up with costs. He held the investments anyway because he told himself the market would recover. Then a year later, interest rates stayed higher for longer, and the stock he bought at 50 started slipping again. When it hit 40, David told himself he would wait. When it hit 35, his credit card balance got worse because the real economy was not recovering at the same speed as the charts. Finally, when he needed cash, he sold at 35. He did not lose because he did not understand finance. He lost because his timing and his cash flow were never aligned with the market cycle. Now take that same concept and zoom out to housing and liquidity. When liquidity floods the market, investors buy. But when liquidity gets drained, everyone tries to sell at once. And here is the part nobody wants to admit. During a liquidity crisis, selling becomes an act of desperation. You cut price to attract buyers. But buyers also become desperate, and they do not show up at the same speed, so prices do not stabilize, they gap down. In other words, when you treat the market like a calm marketplace, you forget it is also a crowd. And the crowd does not behave rationally when survival is on the line. Now let's escalate. The second uncomfortable mechanism is this. Smart money does not just buy after panic, it sells before panic, when it can still sell into optimism. Liquidity is not one thing, it has timing, depth, and access. When large investors unwind, they do not do it in one day like a retail trade. They do it quietly over months because they know that unloading too fast crashes prices. This is why, historically, huge profits often appear right before major market downturns, not because the downturn was good, because the smart investors got out while everyone else was still calling the market unstoppable. Think about the pattern you have already seen in your newsfeed. Big corporate leaders selling shares is always framed like they diversify. But in a liquidity squeeze, diversification is not neutral, it is risk management. Some of them sell early because they understand that when the liquidity tide turns, asset valuations can collapse even if the economy still looks fine in the short term. In 2026, you can actually see this behavior in the timing of insider selling and large-scale corporate liquidity behavior. When executives sell consistently while retail investors chase the peak, you should not assume it is luck. Assume it is access. Assume it is knowledge of liquidity constraints. And assume it is the same reason a lifeguard warns people who are already far from shore. They warn early because the warning is not meant to feel dramatic. It is meant to prevent drowning. Now link that to AI and jobs. In the old world, people believed that if the economy grew, their paycheck would eventually follow. In the new world, AI and automation decouple growth from employment for large portions of the workforce. The headline economy can look fine because productivity is rising. Meanwhile, the labor market for certain roles becomes a revolving door. The middle class becomes a churn machine, fired, rehired, underpaid, reskinned into a new title, then replaced again by new tooling. So when the market rallies, the rally can be real for asset holders and fake for everyone else. That disconnect is not an accident. It is how liquidity policy transmits itself through the system. And now we move into the third mechanism, why the Fed reverses course even when inflation is still not at the target that matters. Official explanations are always elegant. They say inflation is complex, they say growth is evolving, they say financial conditions need to adjust. But you can infer the hidden reason by looking at what the Fed fears. A liquidity-driven banking problem, not a consumer price problem. Here is the key idea you need to understand. The Fed drained liquidity because in normal conditions, draining reserves helps cool lending. But the United States has also engineered its banking system to operate with leverage. Banks borrow reserves and then create loans that cycle money inside the system. When reserves fall too far, the cycle becomes fragile. A small stress event can turn into a funding panic. In the last few years, the world watched bank failures and financial system stress in multiple episodes. In 2023, you saw failures that reminded everyone that the banking system is not a museum. It is a set of interlocking promises. If enough promises fail at once, the system needs backstops, not slogans, backstops. The Fed's balance sheet policies are part of that backstop architecture. When it says it will stop shrinking, it is signaling that it wants to prevent reserves from dropping into territory where stress accelerates. That is why the announcement matters even if your TV host frames it as good news. It is not good. It is emergency maintenance. Now let's translate that into a number, because vague talk is how people stay asleep. When the Fed shrank its balance sheet after 2022, it removed a massive amount of assets. If you think in terms of the scale of global reserves and money supply dynamics, This is not a gentle adjustment. It is the kind of tightening that can turn small funding issues into bank solvency concerns. And here is where it gets darker. Liquidity drain is not confined to the United States, because the world runs on the dollar. If the dollar supply of liquidity tightens globally, other countries face higher dollar funding costs. That means they cannot smooth risk as easily. It means they may hesitate to invest. It means they may need to borrow at worse terms. It means the global economy can slow even when the United States looks resilient. That resilience in 2026 is not because American households are doing great. It is because liquidity can be injected into the financial system and then into asset prices that react instantly. The stock market can keep hitting new highs while millions of people are still stuck with the same income problems. That is not a moral judgment. It is a structural outcome of how policy transmits. Now you might ask, if the Fed is worried about liquidity, why not tighten less earlier, or why not wait? The answer is unpleasant. Central banks want to avoid admitting weakness too early, because once markets smell weakness, they panic, and once markets panic, the cost of intervention spikes. So they wait until the failure risk becomes undeniable, then they act. That is why you see the Fed act in a way that feels late. It is not late by accident, it is late by design. They want to keep credibility, they want to avoid triggering bank runs. They want to prevent a self-fulfilling collapse of confidence. But here is the trap for you. If you are a normal person, you do not have the ability to wait calmly like a central bank. You do not have a balance sheet. You have a paycheck. And your paycheck is not immune to interest rates, insurance costs, and rent. Your paycheck is not protected by the Fed's credibility strategy. So the moment liquidity stress shows up, you experience it as slower job hiring, increased credit card usage, higher delinquency, and the gradual turning of emergency into routine. In 2026, credit card debt is not just some extra spending. It is a system-level signal. When revolving debt rises, households lose the ability to absorb shocks. Delinquency rises later, but it starts as stress in spending patterns. And when delinquency rises, banks tighten credit. When banks tighten credit, small businesses suffer. When small businesses suffer, jobs become fragile. That loop is why liquidity and your daily life keep colliding even if you never read a Fed report. Now let's do a pattern interrupt here, because the story always tries to distract you with stock market charts. Those charts can look fantastic while the underlying economy gets worse. In the United States, you have seen the phenomenon where the stock market rebounds and climbs even after bank stress and unemployment anxiety. If you only look at the S&P 500, you would think the world is fine. But if you look at credit spreads, delinquency rates, and reserve levels, you see a different picture. So which one is true? Both. The stock market is a machine for pricing expected cash flows and discount rates for companies and asset owners. Your life is a machine for surviving household cash flow constraints. They are not the same. Now here is where the cliffhanger starts, and it is the part that actually explains why the Fed's pause is not a resolution. When the Fed stops shrinking its balance sheet, it might slow the drain. But stopping the drain does not refill the empty second layer of liquidity support immediately. And that is where the real risk is hiding. After 2008, the United States built multiple backstop layers. One layer is reserve requirements and buffers within the banking system. Another layer is the ability for institutions to park money overnight or near overnight through the Fed's tools. In plain language, when the system runs out of safe places to hold cash, stress leaks into markets and into banks. During stronger liquidity years, these layers are robust. During stress years, the layers can become thin, and once thinness reaches a critical point, you get a wave of failures or forced contractions. That is why the timing matters. If the Fed drains too much and then gets forced to pause, you do not get recovery. You get temporary stabilization while the underlying shortage remains. This is not theoretical. It shows up as a scramble to find stable funding. It shows up as financial institutions becoming less willing to hold risk. It shows up as global investors demanding higher yields to compensate for perceived instability. In 2026, with climate-driven economic disruptions, there is also another stress channel. Insurance markets have been collapsing in parts of the United States and elsewhere as climate risk repriced. When insurance becomes unaffordable or unavailable, households and businesses face higher costs. They also face higher mortgage and rental friction. Migration costs rise. Construction patterns change. That means the macroeconomic stress is not only financial, it is physical. Meanwhile, AI-driven job shifts are reducing labor bargaining power. So households have fewer buffers. Combine that with a financial system that is thin in liquidity layers, and you get a society where emergencies are more frequent and survivability is lower. Now bring it back to the Fed. If liquidity is thin, why announce a shift toward lower rates? Because lowering rates can reduce the immediate burden of interest costs and can reduce pressure on the yield curve. But if the underlying liquidity shortage is structural, rate cuts are like putting a lid on a boiling pot while the stove still runs too hot. You can slow the boiling, but the danger does not disappear. And now I need you to consider the fourth mechanism. Why the dollar can weaken while asset markets strengthen, and why that contradiction is exactly what smart investors exploit. When the dollar index falls, it implies that global capital may be rotating. It can mean international investors buy other assets. It can mean the dollar is less aggressively demanded. It can also mean the United States is exporting financial risk. In other words, money is leaving the place where it previously felt safest, not because the global economy is thriving, but because investors are repositioning around expectations. But in a liquidity-driven world, smart money does not just chase stability, it hunts liquidity conditions. If the Fed signals a pause or shift, asset prices can jump even as the dollar weakens because the immediate liquidity injection to financial institutions can support risk assets. That means you can have a stock market rally while the currency and real economy diverge. Retail investors experience divergence as confusion. They hear that inflation is cooling, then they see housing prices still rising. They hear rates might come down, then their rent still increases. They hear recovery, then they see layoffs in the middle of corporate reorganizations. The confusion is the feature. It stops people from connecting the dots at the moment when the dots matter most. Now let's return to the original question that sits under all of this. Why does the Fed stop draining when it still claims inflation is not solved? Because the Fed is not just managing inflation, it is managing risk in the financial system. So when the Fed shifts policy, it is because the cost of continued tightening became too high. And the cost is not measured only in consumer prices, it is measured in funding stress, reserve scarcity, bank balance sheet fragility, and the speed at which panic could spread.